Welcome to the Black Wealth Attainment and Retention Program, also known as BWAARP.
Presented by the Los Angeles Urban League in association with Parkside Economic Development Corporation.
BWAARP enhances your ability to acquire and sustain wealth that you can pass down to your heirs.
Want to know how to reduce the wealth gap between the white and black community? Lean in. We got you.
This workshop series is designed to empower you.
Our team of experts cover the topics that are most important for you, your family, and community.
For over 100 years, the Los Angeles Urban League has been a powerful advocate for African Americans and other minorities. We provide access to pathways for personal and professional growth.
The Los Angeles Urban League continues to lead the fight for fair and equitable policies that enable Black Angelenos to increase their personal and business net worth by more than $1 billion this decade.
The Urban League's partner, Parkside Economic Development Corporation, has served the Leimert Park and surrounding communities for over 20 years.
Awarding annual scholarships, providing financial literacy training, along with health and wellness seminars.
BWAARP was conceptualized by LA Urban League President and CEO Michael Lawson and Parkside EDC Chair and CEO Reverend Jaron Smith. And BWAARP welcomes Cynthia Hurd, COO of the LA Urban League.
Our mission is to minimize the erosion of Black home ownership, ensure business growth, and promote physical vitality and mental health as the foundation for changing statistics like these. Wealth is defined by what you own versus what you owe. This is especially important as you near retirement age.
Remember, it's not only about how much money you earn, it's about how much you keep and how you leverage it.
It's time to level up and secure our financial foundations with BWAARP, moderated by Reverend Jaron Smith.
Good evening, everyone, and welcome to the fourth edition of BWAARP, the Black Wealth Attainment and Retention Program for 2023, presented by the Los Angeles Urban League and produced by Parkside Economic Development Corporation. BWAARP was birthed out of a conversation Michael Lawson and I had a little while back about gentrification, the decline of home and business ownership, and lack of financial resources and education available to our community. Thus, we present BWAARP, featuring qualified and concerned financial and well-being experts that educate, motivate, and inspire us to attain, retain, and pass down legacy wealth. Our short-term goal for this program is to close the wealth gap between white and Black households with a long-term vision to fulfill the Los Angeles Urban League's desire to build a Black Wall Street right here in Los Angeles. I want to thank the Los Angeles Urban League for their commitment and tremendous support that they give to BWAARP. In the coming weeks, we have 2 sessions left, and we're going to cover a couple of interesting topics, one being crypto, whether we should cash in or cash out. There's a lot of conversation about crypto, so you don't want to miss that one so you can get the details of what's really going on. And our last workshop will be the wealthy mind and body. As we all know, without a healthy mind and a healthy body, wealth has a little less meaning for us. Tonight's presentation is Preserving Your Assets in Tough Times. This presentation was put together by a dynamic husband and wife team, Jaron, aka JP, and Michelle Hamlett, principals of Retirement Choices of California. If you have any questions during the presentation, please put them in the chat or in the Q&A, and our virtual producer, Jacinda Moden, will make sure that you get an answer during the question and answer portion of our program. Jaron P. Hamlett Sr. has been a successful entrepreneur and business owner for over 30 years. He began his career in financial services after receiving a bachelor's degree in public administration from California State University, Chico. In 1987, Mr. Hamlett expanded his financial services offerings by obtaining his insurance license with the New York Life Insurance Corporation. The pairing of his real estate license that he had already secured and his insurance license helped him become a top residential and commercial realtor, investor, and insurance advisor. Mr. Hamlin played a significant role in the founding of the USC Minority Real Estate Development Program, the National Black Business Council, and the Mentor Network. After becoming one of the nation's top producers for AFLAC, JP launched Hamlett Benefits Group, which is the parent company for Retirement Choices of California, that provides financial counseling and retirement planning strategies to the public sector, nonprofit organizations, and businesses. And his partner, Michelle Hamlett, brings more than 17 years of financial service industry experience to her role at Retirement Choices of California. During her career in the financial services industry, she's held management positions with several prominent investment banks, including vice president at Goldman Sachs, New York. Michelle utilizes her vast management experience in her role as the firm's chief operating officer, where she is responsible for the management and strategic planning for the firm. Michelle has a master's in business administration from Purdue University, which enhances her ability to provide consultative service solutions, advice, guidance, and education to clients as the firm helps them navigate the increasingly complex and ever-changing retirement planning landscape. Jaron and Michelle, thank you for sharing with BWAARP.
Good evening, Gerald. Good evening, everybody. I think I have a little feedback here. Okay, thanks, Gerald. Good evening, everybody. I think we have Michael Lawson from the Urban League and also Cynthia Hurd on this workshop or webinar Zoom call. So good evening to them especially, and thanks for the opportunity to present some information about preserving your assets and also just looking at the landscape in terms of the challenges that we face now economically, whether it's inflation or the threat of recession. But first, I want to kind of get into talking about tough times, because everybody has a different perspective, or everybody seems to think there's tough times, you know, based on their situation, and everybody's situation is different, right? So I'd actually like to kind of get a response, Jacinda, from the audience in terms of what they think tough times are. Is it, you know, because of, you know, you lost your job, or you're unemployed, or, you know, you had a death in the family, or, you know, what are some of the tough times that you've experienced or maybe experiencing now? Can we do that for a minute, Jacinda?
Yes, sounds good. Everyone, feel free to share in the chat.
Yeah, we're just going to talk about tough times right now. And, you know, obviously, you know, the United States is not in war, or, you know, you're not homeless, I'm assuming. But there are some challenges that we all face. And I want to just kind of take a poll or find out, you know, what you might be going through that may impact your financial wherewithal. Death of a family member, I see that. Yeah, that obviously creates challenges, especially if it's a parent or somebody that generated income, or, you know, specifically your spouse. If you have a spouse that passed away, then obviously that's, you know, a huge challenge, because perhaps your income has decreased for the household. And I mean, not just emotionally, but economically, that creates a major toll. loss of stock value. If you have an account or a portfolio and maybe you're still working and you have a 401k and your stock value or your portfolio value has decreased because of the market collapsing or just depreciating or just losing steam, maybe it's because it's a bear market as opposed to a bull market. Divorce is obviously can be very significant and very impactful in a negative way. You had two income earners, perhaps, and now you have to kind of toe the line yourself in terms of mortgage payments, taking care of kids. Divorce can be debilitating. Also, disability. If you have a disability and now you're working a lot less, or you're doing a job that physically you can do versus what you were doing previously to your disability. And so there's a lot of different scenarios where someone feels that the challenges that they're going through prevent them from being successful or accumulating wealth, growing their wealth. And certainly they're not even thinking about preserving wealth because they're still in the income generation, or they're trying to just generate more resources or more revenue or just more household income. And so everybody has different perspective on what tough times are, specifically as it relates to them. Inflation, obviously we're in a period of inflation, and that's why you have the Fed increasing the Fed funds rate. They just increased it by 25 basis points the other day. They're trying to reduce or eliminate or certainly bring inflation under control. And so we look at how inflation impacts your discretionary dollars, whether it be grocery shopping or buying a car, or obviously you're paying a little more for goods today than you would have paid last year. And you kind of look at the interest rates that we're seeing now. Everything is going up. I think the mortgage rates now are close to 7%, where last year they were about 3%. But now you can also look at the bond rates and treasury bills. If you are a holder of a treasury note or a bond, your returns are better now than they were since maybe 2008. And so before we get into preserving assets, I think we need to talk about actually creating assets. And so we'll kind of get into a presentation. I think you might see it on the screen. I'm going to switch my camera, I believe, because my presentation is on the right side. So bear with me for 1 second, audience. Okay. Okay, so we just talked about tough times. So let's kind of get into the presentation. We're going to talk about creating personal wealth. What can you do to create personal wealth? Obviously, some people are very fortunate, and I don't know if anybody on this Zoom call is what they call a trust baby, or you inherited a lot of money, or perhaps you played the lotto and you're now a multimillionaire. But most people, certainly myself and my wife and most of our friends, we had to work and just really save money. And so here is a life cycle investment guide. It kind of talks about where you should be at a certain age. So, while you're in your 20s, it's great to invest in stocks because you have time to go through bear markets and go through bull markets. And, over time, the stock market generally does pretty well. And so you're not, worried about being, super conservative when you're young. You want to keep some money in cash, and 20% of your portfolio could be in bonds, and maybe you're starting to look for a home, purchase your first home. Obviously real estate is a great investment in terms of looking at appreciation and building equity and then you can parlay that into other investments or additional real estate. And as you get into your 30s, maybe you've had kids and you're still paying off student loans, or maybe the student loans are paid for, but you want to be a little less risque in terms of your portfolio. And so we drop it down to 55% in the stock market, increase the bonds, or the ratio of bonds to maybe, let's say, 30%. Cash is about the same, real estate is about the same, but maybe now you're looking at purchasing, an investment property. You've already purchased your primary residence, and now you're looking at maybe purchasing a condo as an investment property, or some units, maybe a duplex. And then as you get towards 50, obviously you're getting closer to retirement. So hopefully you've done some things through your employer. If you are a W-2, or if you're employed, you want to make sure you're taking advantage of some of the plans that are offered pre-tax through your employer, whether it be a 401k or a 403b or 457 or IRAs or Roth IRAs. But you really want to start thinking about retirement. The sooner the better. I mean, it's all obviously about saving. The more you save, the better off you'll be. And you can kind of see how we mix the stock portfolio. Now it's down to about 44%, because you don't have as much time as a 20 or 30-year-old if you lose money. If you lose money, then trying to recapture or recoup the loss becomes a little more difficult as you get older. But perhaps you're, again, buying more real estate and increasing your bond portfolio. And as you turn 60, obviously you're looking at different things in terms of expenditures, reducing your expenses so you can comfortably afford to retire without ever having to think about going back to work. And so we'll kind of get into the life cycle investment guide just a little more on the next slide in terms of where you should be and, what stage of life are you in? Are you still in the building or growing, or are you now trying to preserve, or are you now trying to think about your legacy and also passing on wealth to maybe your kids or your heirs? Okay, so we just kind of talked about in your 30s. We skipped the 20s because I think based on what Reverend Jaron told me, that most of the attendees would be over 30 or maybe even over 40. But again, make sure you take advantage of employer-sponsored plans. Quite often you have employers that offer you 401ks, and they might do a match. So whatever they match, whether it's 3%, 4%, or 5%, that's free money. So you're using pre-tax dollars to fund your retirement savings through your employer. And sometimes I think people don't understand in their 20s or 30s or maybe in their 40s how the compounding effect will put you in a really good position to have a lot more assets as you lean towards retirement. And so maybe having a rule of thumb of saving 10% of your paycheck and putting that in your 401k, or splitting that between your 401k and maybe a traditional IRA might make a lot of sense for you. But again, the more you save, the more you'll have. And try to stay away from investing in things that you don't understand, or that could provide more risk than you can actually comfortably accept. And then also, I think insurance is so important. And again, we're kind of focusing on creating wealth and ultimately preserving it. With insurance, it's some people call it a necessary evil, but you can use insurance policies to your advantage, like a permanent plan, whether it be whole life or universal life, provides cash value. You can pull money out tax-free by using the loan provision. So you might have purchased a policy 20 years ago or 30 years ago, may have forgotten about it. You might be paying premiums, or you may not be paying premiums, but you always want to look into your insurance policies, whether it's a term or a whole life or universal life or index universal life, because you may have more supplemental income that will give you a greater basket of funds to draw from at retirement. And so as we go to your 40s, we'll go next slide. Make sure you understand how your money is being invested. Sometimes you let your advisor, if you have an advisor, if you don't, I'd certainly consider getting an advisor, someone that you trust, someone that gives you good advice, and someone that allows you to, investigate further or encourages you to investigate, and somebody who's, transparent. A financial planner can certainly give you a lot more resources, a lot more insight to economics or different products that you may not be aware of. And so we'll hit the 50s. If you're putting money into a IRA or Roth IRA, you can probably put in more as you turn 50. I've had clients that were putting in $500 a month and $1,000 a month. And when they turned 50, they started putting in $2,000 a month into their traditional, or not traditional IRAs, but their 403B or 457. But put as much money in your supplemental retirement accounts, especially if you're using pre-tax dollars. Pre-tax dollars really give you some advantages because it lowers your taxable income, and now you're paying less taxes and you're saving more. We talk about long-term care in your 50s. If you're in your 50s, if you haven't looked at long-term care, I would certainly do that. Not that you're planning on becoming disabled or needing care, but you never know. If you had a great plan with your spouse and your family, and then all of a sudden you became disabled and you weren't able to work, and you needed some care, that could wipe out everything that you worked so hard for. So, check with your employer, or even go online or talk to your financial advisor about long-term care. And so we want to focus on, retirement. I mean, most people, after they turn 50, they may want to stop working. They may not like their employer or their staff or employees, or they may just, be tired of going to work, whether it's driving, or nowadays people are at home working and, continue to generate income. But they may be frustrated. They may not want to get up early anymore, or they may not want to, do some of the things that the job requires. And so it's nothing wrong with thinking about retiring at age 50 or 55 or before 60, but have you done the proper planning to retire without having to think about money or working after you retire? After that sunset date, can you afford to maintain your lifestyle without generating income through your employer? And so some things you can control, right? Like where you invest your money, whether you're going to save more money or spend more money, or save less and spend less. I would certainly encourage people that are trying to build wealth to save as much as you possibly can and eliminate some of the expenditures that don't give you any return. I mean, how many of us have a lot of clothes in the closet that we haven't worn since the pandemic, or even before the pandemic? Could be shoes, purses, dresses, suits. I mean, most people that I know probably have $50,000 to $100,000 in things that don't provide any return. They're not artwork, they're not investments. It's just something that made you look good or made you feel good, but that money could have gone maybe towards your retirement account or towards savings towards your future. You do have some control over who you work for and your income to some degree, and how long you'll work. And obviously, if you're staying healthy and you have good genetics, maybe you'll live to be 80, 90, or 100 years old. So there's some control over the longevity, but in things that you can't control, like market returns or inflation or taxation, or even policies that are placed upon us by the federal government or state government or local agencies, you have no control of. And so you really want to make sure that you're able to navigate your retirement so that you can get to the point where you can comfortably step aside and enjoy the things that you've always wanted to enjoy. Okay, I'm going to press forward and start moving a little quicker. Michelle, please jump in. My wife and my partner. We can go ahead and go to the next slide, and then I'm going to have her maybe talk about the 60s, if you don't mind, Michelle. Oh, you're not on the mic? Okay. All right. So at age 60 or while you're in your 60s, again, think about spending and reducing your expenditures, and make sure that you have your Social Security benefits lined up. Whether you take Social Security benefits at 65 or 63, obviously the longer you wait to receive your Social Security benefits, the more you'll get. And then also, think about, again, Medicare. Before you turn 65, you certainly want to look at your Medicare options. Nowadays, if you're employed or if you're self-employed, you might be spending, $500 to $1,000 just for health insurance. I've had some friends that were happy to turn 65 so they could qualify for Medicare, which would dramatically reduce their costs or outlay for health insurance. Okay, as you turn 70, perhaps you're already retired. You're starting to look at taking withdrawals. For those of you that don't know, you have a minimum required distribution. So even if you don't need the money, and thank God if you make it to 72 and you don't need money from your 403B or your IRA or your 401k, you've done a few things right. But at that time, when you turn 72, it used to be 70 and a half, but now it's 72. You want to start taking distributions. If not, you're going to be hit with some tax penalty, and that certainly reduces your accumulation value from your plan. So if you're in your 70s, certainly look at your minimum required distribution. It's usually about 3.5%, maybe 4.5% of whatever you have in your account. So if you have $100,000 in your IRA, you're going to need to take out between $3,000 and $5,000 per year to avoid any kind of tax penalty. And then also, if you own a home, I'll just wrap this up, and you need cash. My father is, believe it or not, he's 90, he's 91 now, and he did a reverse mortgage, and he loves it because he was able to stay in his house and then also pull money out to meet his personal needs or just take care of his lifestyle. Okay, with insurance, we've talked about a little bit, but it's just more than life insurance. It's also liability insurance, or if you have a business, there's buy-sell agreements or key man insurance that you want to be certainly aware of. And having insurance will allow your family to provide for themselves if something happens to you. But again, I want to make sure that people understand that life insurance is also for the living, because you can supplement your retirement income with the cash value from your life insurance policy. If you have a term policy, you may want to check that out or kind of understand it a little better. It might have been for a term of time, could be 10 years, 20 years, or even 30 years. But at the end of that term of time, then you have no cash value, and all you've done was pay premiums and have nothing to show for it. So make sure you understand what kind of life insurance you have. Some people are now looking into selling their life insurance policies to different insurance companies that are certainly interested in investing in your life insurance policy, so that when you pass, obviously that had become an investment for them. I wouldn't do that, but it just depends on your circumstances or your situation. And also make sure you have your personal items or everything that you've worked so hard for protected. And we'll talk a little bit about maybe a living trust, or even talk about wills and estate planning in just a second. But make sure you have the right team around you to give you the proper advice that you need as you're creating wealth. Okay. And so again, we talked about what insurance does. It's better to have it, not need it, than to need it and not have it. I know it's a cost that people try to avoid, but It's just a part of life. You can turn your insurance into, income down the road. Okay. It also gives you a chance to diversify your retirement savings. You're talking about leaving a legacy or building a legacy. If we had grandparents or great grandparents that had life insurance policies, and when they passed away, if they left, us enough to go to college or start a business or get married or buy a house, how further along would we be? But it also provides cash to your estate so that if your family has assets, or if you leave assets behind, they don't have to sell those assets because there's enough cash that will preserve their assets or the assets that you work so hard for. And then for a business, it's also really important to make sure you have insurance. If you have a partner, again, you don't want to partner with your wife's spouse. Theoretically, if your partner passes away, you want to own the business outright. So having a buy-sell agreement or key man insurance might provide the right tool to allow you to become 100% owner of the business. Your partner, if you pass away or decease your partner is not interested in being in business with your wife or your spouse. And so having a buy-sell agreement is super important. Okay, spending habits. That's really important. If you're spending too much, or if you're spending, more than you're generating in income, or more than your cash flow, that's a problem. Obviously, we like to go out and dine and travel, and we like to go to ball games and play golf and buy gifts and just travel and live life. But there's got to be a balance between spending and saving, because you can actually find yourself in a situation where you're 40 or 50 years old and you don't have much in your savings account, and you're paying maybe high interest rate on credit cards. It's eating up all of your income, and so we need to really kind of monitor aggressively our spending. And I don't want to say wait till you're 40 or 50 or 60. You want to monitor your spending, at an early age, because how much money could you have in a savings account now, whether it be an IRA or just a general savings account or regular savings account? How much money could you have in your savings accounts if you spent a lot less along the way? And I know it's hard. Some people think that, hey, I want to live life now. I'm not going to worry about the future. But the future eventually comes, and if you haven't done the right things in terms of saving or monitoring your spending, you could find yourself at a crossroad. You could end up working till you're 70 or 75, or maybe you pass away on the job because you couldn't afford to retire. So there's got to be a balance between spending and savings. So we certainly recommend that you diversify your savings, whether it's stock or bonds or real estate, mutual funds, bonds, T-bills. There's so many different products that you can look into. Real estate, obviously, in California has been great for most homeowners. Could you imagine? And some of you have bought homes in your 20s or 30s, and you still own that home, and you've seen maybe 500% appreciation. And as you get older, obviously the chance of you holding on to a property for another 10 or 20 years and seeing those kind of appreciation levels is pretty unlikely. And so as a young person, or whether you're 20, 30, 40, or 50, buying real estate in California seems to make a lot of sense, especially if you buy it in a market or in an area that has a history of good appreciation, and there's a lot of commercial activity in the area. But precious metals, art, again, insurance, there's so many different things that you can invest in, and nobody really knows in advance what's going to perform the best over a significant period of time. And so just, have a diverse portfolio so that you can take advantage of market swings, especially if we're in a bull market. Here's just the power of compounding, which really talks about not just getting interest on your savings, but interest on your interest. Here's 4 different scenarios. It could be whether it's a mutual fund or a basic savings account, or it could be a stock from a different country. But here, if you put in $100,000 in each of these scenarios, at 6%, you'll see in 10 years, it's about 179,000 versus 441,000 if it was a 16% return. I'd love to get a 27% return. There are some products or there are some strategies that have provided 27% plus returns over the last 20, 30 years. At a mutual fund, let's just say this particular strategy gave you a 20% return. Your $100,000, and remember, this is just one-time lump sum, just a contribution, that investment now is at $619,000. So when you're spending money, think about compounding, and if you were to save that money, what would it look like 10 years down the road or 20 years down the road? You can see in 20 years, $100,000 just at 6% gives you $320,000. I mean, who could use an extra $320,000 for their retirement or for whatever they want? And so it's just nice to know that money does work if you allow it to, because of the power of compounding. And here's a chart that talks about risk. Money market investments or bonds have very little risk. But as you go higher on the chart here, blue chip stocks or equities provide a little bit of risk. Mid caps more risk. Small cap equities or stocks have higher risk, but they also have higher potentials for gains. If you have a portfolio that has been returning 8% or 12%, you got to be happy. Last year, if you had money in the bank, you were getting nothing, whether it was a T-bill or a savings account or just a money market account, you were getting very little. Today, it's a little different because of the way the economy has been growing. And then also, this is just showing you, it may be hard to read, but when stocks were down, this is since 1929 through December 2022, when stocks were down, bonds were usually up. And you can see there's been some really good years with bonds. And I think now bonds are, again, more attractive now than they've been since 2008. So you may want to, again, diversify, having bonds in your portfolio as well as stocks, maybe more bonds as you get closer towards retirement. Okay, some do's and don'ts. Make sure when you make investments that you understand what you have and why you purchased them, and you have a plan for those investments. And make sure you understand that investing is for the long run. I don't know any quick opportunities where you can take $10,000 and be a millionaire in a short period of time. And so it does take time, and investing is a long run game. It's like a marathon, but don't be discouraged. Investments are worth a lot as you see their growth and also their returns. And lastly, don't buy what you don't understand. Somebody tries to sell you something that you don't understand, then I would be very reluctant, or I would certainly take my time to investigate if you thought it was worth it. Okay, I want to talk a little bit more now about, if you have assets, you've done those things, you've created some wealth for you and your family. The virtual family office, we actually have a partnership with an organization called the Elite Resource Team, and we're able to provide various services to our clients, whether it be tax planning, working with CPAs, business advisory services, maybe more advanced planning. Sometimes CPAs are more focused on accounting or tax preparation, but with our experts that we work with, we can provide more business advisory services, mitigate risk, talk about wealth management. We have estate planning attorneys We have living trust experts on our team. And so as opposed to working with, one CPA and a different attorney, and, you're going all over the place for these services to manage your wealth, wouldn't it be better if there was some collaboration between your experts, that you were able to go to one place and have your needs met in terms of, not just continue to build wealth, but also to preserve it and also to pass it on to the next generation. And so we're big advocates of the virtual family office. So now let's talk about, preserving wealth and creating a legacy. We'll talk a little bit about estate planning, which is really important. And if you don't have a will, then why don't you have a will? Or if you have a living trust, have you reviewed it recently? If you don't have a living trust, then let's talk about, how a living trust allows you to be very intentional with the distribution of your assets if something happens to you. And for business owners, succession planning, I think, is so important. Even though on this slide it says, 65% of the people that were polled in this particular survey, they actually had, they said they had a succession plan. But, saying you have a succession plan and having an active or valid succession plan could be two different things. We've worked with business owners that had a succession plan, or at least they said they did, but they didn't really have a plan that was current. It hadn't been reviewed in many years. And you can imagine, if you're a business owner or you own a franchise and you have a succession plan, well, maybe the person that you want to succeed you, maybe your kids or a friend, they're not able to take over the business because the franchisor or the manufacturer, they don't approve of who you decided to be your successor. And so having a business, it's so common that people who have businesses actually end up selling those businesses, or the family members end up selling the business upon their death because they didn't have a good succession plans or a good succession plan. And so succession plans should be integrated with your estate plan. Everybody here on this call knows people, whether they're family or friends, that, somebody passed away in the family and there was a lot of turmoil and disagreement, and, you fell out with your sister, you fell out with your brother, and, sometimes those relationships are, hard to repair. Once you show that money is more important than, your sibling, it's hard to overcome that. And your parents or, your mother, or your father certainly wouldn't want that. So succession planning and estate planning allows you to have a plan while you're alive, so that when something happens to you, there's no confusion. Your intentions have been communicated via your living trust or through your estate plan, or through your attorney. And it's also a good idea to make sure that you bring in your family members, especially your heirs. A lot of business owners today have children that are not interested in controlling the business or running the business, even working in the business once the parent passes away. So what do? How do you maintain the value of that business and pass that on to your spouse or your kids or your grandkids? And so it's really important to have some kind of plan that allows you to state what it is that you want to have happen to your assets when something happens to you, and also to reduce the tax burden. It could be estate taxes, or it could be capital gains, but having a good estate plan and having a good team of experts or a brain trust around you can, mitigate a lot of taxes and a lot of confusion. And so understanding estate planning, let's kind of get into this slide. Michelle, if you want to go ahead and move it. So what is estate planning? And it really is just a matter of creating a legacy and preserving your assets for future generations. Cognitive dissonance, it's when somebody says, hey, I have a strong belief about life insurance or a living trust or estate planning, but they just don't do it. So they kind of disconnected. And some people are not realistic about, having plans, or they know what the right thing to do is, but sometimes they just don't do that. Okay, and there's also a lack of urgency. How many people on this call have not, put together a will or a living trust, or talked to their parents about estate planning or some of the real estate in the family portfolio, because you think you have time, and now your parents are, 70 or 80 or 90, or maybe they've passed away, and things were a mess. And so don't allow that to happen to you, and don't have your children, your grandchildren lose out on value, or lose out on the assets that you've created or worked so hard for. So, work with a sense of urgency. Beneficiaries, take a look at, all of your contracts, all of your life insurance policies, your retirement accounts. Make sure you have the right beneficiary. If you were married and you got a divorce, why is your ex-spouse still the beneficiary? Perhaps your kids should be your beneficiaries, or if you don't have kids, maybe you want to create maybe an organization, or you want to create a charity, so that the things that you've created can be passed on. I have a client that has no kids, but he's a fencer, and so he created a charity or a trust that would provide funding for Black young men and women that want to pursue fencing. And so you can create your own charity, but make sure your beneficiaries are accurate. If you haven't looked at your beneficiaries on your pension, or on your IRAs, on your savings accounts, I would certainly make a strong effort to make sure that everything is accurate, and review everything as often as you possibly can. So how will your assets be distributed? That's up to you. You can create a revocable living trust, which means that you can make changes while you're alive. But it's certainly a good way to make sure that your kids are taken care of, and everything, again, that you work so hard for doesn't go to vain, or it's not in vain. And so in your living trust, you can pick your power of attorney for your financials. You want to pick somebody that would have the same mindset as you economically or financially. If you have a child that has special needs, or even you may have a child that could be addicted to drugs or whatever, just needs care, you want to make sure that whoever the power of attorney is, they can make sure that your child or your children are cared for, not to obviously purchase drugs, but make sure they can pay rent, or they're not homeless. I mean, homelessness is obviously something that's affecting a lot more people now than it did, 10 or 20 years ago. And then the other power of attorney is for healthcare. I mean, if you become disabled, you need somebody to act on your behalf. One of your good friends, or your sister, or your brother, but they could be the same person. The POA could be the same person for healthcare and finances, but when you put together your living trust, you certainly want to identify people that have your best interest and your family's best interest in mind. If you have kids that are minors, you can name a guardian, somebody that would take care of your kids and love them the way they need to be loved, to help them to get through the difficult times, and to get through school, and hopefully to become normal and have good lives, get married, and have children, and contribute, so they can create a legacy for their kids. And then as we move forward, there's a difference between wills and trusts. I'll just say really simply, wills don't avoid probate. and all your information is public. There's so many entertainers or celebrities that, had wills and thought, their assets would be easily passed to the person or the people they wanted the assets to go to. I think Prince just recently, I think he had a will, but it didn't avoid probate in terms of his property or his assets, any of his real estate, and all that was public. So in a will, everything is public. Even though it's better than not having anything, a trust will make it private, avoid probate, and you can control it. You can be the trustee while you're alive, and then you have a successor trustee that will govern your affairs once you've passed on. And we're getting down to the end of this. Why do I need a will? Again, it's in this case, if you have a trust, trust usually come with medical directives, wills. And so if you already have a trust, more likely you don't need a will. Do you need a will? If you don't have a trust, it depends on your assets. If you don't have a home, if you don't have much to pass on or to distribute to loved ones that you're passing, then maybe a will is sufficient. But we can certainly talk about that anytime that you think it's important. And again, if you have assets, I think estate planning and having a living trust is paramount. Which one is right for me? We can talk about that. Review existing estate plans. A lot of you have parents that have estate plans. Maybe you haven't reviewed them. Maybe you have an estate plan. Maybe you have a living trust that you haven't reviewed in years. Now, things have changed so much over the last 5 and 10 years that your trust or your estate plan may be invalid or may not represent your current estate plan, your living trust, every year or every other year at minimum. And if you have parents that have a living trust, you should have a copy of their living trust. I know some parents are against sharing, that kind of information, but it only helps to make things smooth once they pass away, or when you're no longer in the picture. You want to make sure that your kids are well taken care of. And so estate planning, needless to say, is super important. And sometimes I think it's just a mindset. A 20-year-old can start an estate plan by buying a life insurance policy that's going to, provide a death benefit or a face amount that will be that he'll grow into or she'll grow into. They have the mindset of, I'm going to build an estate, and so it's never too soon to start thinking about building an estate or protecting your assets in the future. And obviously, there's things that come about, or there's things that change. You can go through a divorce. You can lose a spouse. And so you want to be able to have a flexible estate plan or a living trust that you can change while you're alive. But planning for contingencies is, I think, just a smart way to make sure that your assets are protected no matter what happens, or almost whatever, no matter what happens. And so the estate plan leaves a roadmap for your family, makes it easier for them, less confusion, less strife, less confusion, and just less fighting, to be honest with you. All right, I think I'm just about ready to open up for questions, but make sure you're thinking about your charity of choice, or you have a church that you belong to, or you belong to a nonprofit organization. Being philanthropic is a good move. It's helping those that are doing things that promote a mission that you embrace, right? If it's a church or an organization that helps the homelessness or young adults struggling with whatever they struggle with, why not create a trust or just be more philanthropic with your assets we'd rather them go to an organization or a charity that, again, is addressing some of the issues that you think are important, as opposed to, losing assets to taxation or some other risk. So we've talked about challenges. We've talked about things that people say create tough times. We've talked about, a little bit about protecting a business and growing personal wealth. We talked about a legacy. With a business, I think I've been a business owner, or I've been self-employed for, it's actually been 40 years. I started in real estate in 1982. And so my, path has been different, but I would certainly suggest if people want to create more wealth through your employer, it's very difficult, whether you're making, $50,000, $100,000 or $200,000 per year. It's difficult to build wealth that way. And so if you haven't thought about starting a business, I would certainly challenge you to think about it more, during some of the downtime that you have, whether it's, you have to give up more TV or more outings or more golf or whatever. Starting a business could provide you with a different lifestyle and create more revenue for you, or certainly more income for you. And so that's kind of the presentation. Retirement Choices California is my primary company. I'm the CEO there. We also have another company called Advanced Planning Strategies. We do the virtual family office stuff, business advisory services. We have our office number on the screen. We have our email. Please feel free to reach out to us if we can be of help. And we appreciate your time and your attention. And thanks for the opportunity.
Thank you, Jaron, for that great presentation. You did a great job presenting it, even though we all know Michelle is the one who put it together. But we appreciate your time. And those of you who are with us, if you have any questions for Jaron, please place them in the Q&A or the chat. And we're going to turn it over to Jacinda in just a moment to pose some of those questions. But Jaron, I had a couple of questions I wanted to start with. You touched on it briefly, but you mentioned in insurance. And can insurance, if I understood you correctly, you were suggesting that insurance can be used as an investment vehicle and a savings vehicle simultaneously, or either or, depending on the type of insurance you get.
Yeah, savings, investing, certainly having a permanent life insurance plan where there's policy values. I started my policy, it was a whole life with New York Life back in '87. It was a $100,000 face amount. My premiums were only $63 per month. I'm still contributing to it, but I've borrowed money on several occasions. I've since purchased a few different permanent life insurance policies that will have cash value that I can use to supplement my retirement. And you can pull the money out tax-free by utilizing the loan provision. So what that means is, let's say you had a $500,000 face amount and you had maybe $220,000 of cash value. You can borrow up to 90% of that, or let's just say you could borrow $200,000 from that life insurance policy and never have to pay it back. And remember, it's tax-free. Used after-tax dollars to pay the premiums, and now you can pull the money out tax-free. So yes, it could be a great investment, or should be a part of your portfolio, not to mention that it, provides safety so that if something happened to you, that your spouse or your family could still maintain the lifestyle that become accustomed to while you were alive.
And the last question I had is that you also mentioned term policies, and we know if you get a term policy, the premiums tend to be a little less going forward. The amounts could be as much as you choose to buy, but once that term ends at a certain point in time, and you haven't needed it, it just goes away. but I've heard of strategies of using the lower premium term policy, but not wasting the money that you aren't spending on the term policy, taking a portion of that and maybe putting it in an IRA or a Roth or some other vehicle while the term policy is in effect. And then when the term policy goes away, you have something set aside that's just as adequate to take you further. What's your opinion?
Yeah, conceptually, that makes sense. Term policies are, for a term of time. And once you hit that term of time, then the death benefit goes away and you have nothing to show for it. So when people say, I want, a policy, a life insurance policy, but I can't afford, to pay $300 a month, I can only pay $40 a month, but I need, $300,000 worth of life insurance, then they buy a term policy. And then what you're saying is that they would invest the difference. Well, that's assuming they have more money to invest, right? Because if the whole life policy or universal policy was, $300, you're putting in $40 into your term. Does that mean you can now put $260 into a mutual fund or to an IRA? Probably not. Right. But conceptually, it makes a lot of sense. But it also requires some discipline, right? Because if you're if somebody gives you, you're a young person, 20, 30 years old, and somebody says, hey, buy term and invest the difference, but it's up to you. Every month you have to make a contribution or a deposit. I think 90% of the people that I've come in contact with, they're not consistently saving the difference. And so even though initially it made a lot of sense and they wanted to do it, it just didn't work out. So even with me, I was in the business, but I actually decided to, put whatever it was, $63 a month, or that time I was, 22 years old. But even now I have policies that, I pay, $1,200 a month for, but it's just deducted and I don't think about it. I have the wherewithal or the assets to be able to afford the premium, but I know that not thinking about it or not having to make a deposit every month makes it easier for me to see it grow over time.
Okay. All right. Well, we're going to turn it over to Jacinda Moten, our virtual producer, and she can propose any questions that we have in the chat or the Q&A.
All right. So our first question is, what are your thoughts on estate plans and placing deeds of real property into separate LLCs? Regarding charities, if real property needs to be sold so that 2 or more charities can utilize, who leads? The executor?
That's call me, whoever that person is, send me an email or call me. That's a tough question. I don't know if anybody else has that same question on this call, but there's so many different living trusts, and there's so many ways in which to distribute assets or preserve assets, or to minimize your estate taxation. And so, yeah, that's a very sophisticated question. I'd love to address that maybe with the person that sent you that question.
Okay. All righty. Our next one is, what about—
By the way, I think that person knows the answer. They're just trying to see how much I know about it.
All righty. Our next question is, what about taking your Social Security when you reach the appropriate age, 66 years, 2 months, et cetera, and invest it versus waiting until 72 and a half? The yearly amount still increases gradually by up to 8%.
Yeah, so it depends, right, on whether the income you have now is sufficient. Because if it is, you can delay or defer your Social Security, until you're 70, because it'll be a lot larger, or it's relative, right? I don't know about a lot larger, but maybe you were going from $2,000 a month in Social Security benefits at age 65 to $2,500 at age 70. And so, yeah, I think if you want to take it out, it also depends on how long you expect to live, and who knows, if you're planning to live to be 72, then maybe you want to start taking that money out now and use it for whatever reason while you're alive. But even if you plan to live to be 100, you want your Social Security income at 65, perhaps because you have a better way to invest or to use that money. Maybe you have an opportunity to buy some real estate, or you have an opportunity to buy some stock that is, or you buy a horse, thoroughbred, or you buy crypto. I'm not suggesting you buy anything risky with Social Security income, but certainly it's your money, and if you want to get it sooner, the disadvantages you're going to get less, but the advantages you have it now, and you can do some things to increase your net worth by investing it in the right vehicles.
All righty. Our next question is, what does the term family bank mean in terms of insurance?
I've been in the insurance business a long time, and I've never dealt with anybody that has asked a question about a family bank. Is that what it said, family bank? Yeah,
yes, family bank.
Yeah, I don't know. Maybe that's something, a niche, or that's something that is very, I don't know, very specific for a certain type of person. I don't even know if it's for Americans or for Europeans, but obviously, having insurance for breadwinners is, the key, mother and father. And, you can start a plan for your children when they're young so that they have an advantage because they have time on their side, and the money can be used, the cash value can be used for college or paying off debt or starting a business or getting married. But, a family plan, I mean, it sounds like, covering everybody in the family, and, what you do with your premiums or how you want to adjust your policy, the face amounts, that's, depending on how much. Matter of fact, rule of thumb is you should have 10 times your earning or your salary. Obviously you can get away with 5, but the rule of thumb is between 5 and 10 times your salary for parents. For kids, you don't have any income, but obviously if somebody buys a 2-year-old a policy, $50,000 face amount policy, and they're paying $100 a month, that thing could turn into a $100,000 life insurance policy by the time they're 16. And maybe have, $70,000 of cash value they can access for education or down payment on a home or to get married.
Awesome. Or someone had asked, would it be considered family office? Now, is that term familiar?
Yeah, so I don't know what they're referring to if they're talking about a family office, virtual family office. I say virtual now because you don't have to sit around a table with your accountant and your banker and your real estate agent, your attorney. I mean, you can do all that virtually, but that is a family office. It's a concept that's not new. Virtual is more new, but the family office is not new. They've been doing that for centuries. I think, was it the Rothschilds, or they started this because, they had all this wealth, but they had to deal with, so many different professionals to get the things done that they wanted to get done. And so they hired somebody to manage their family office to take care of the bills and contracts and, mitigate risk and, also tax planning. So they had one person that didn't do all the work, but they were the ones that managed all those relationships and collaborated with all those experts.
Okay. All righty. Our next question is, when or would you ever advise a client to cash in a whole life policy?
I wouldn't unless they absolutely had no other resources. At some point, the whole life policy is going to pay off because at some point you're going to pass away. So I would never advise somebody to sell a whole life policy or a universal policy because those are permanent. And again, they provide cash value. So could you imagine, paying $200 a month for 30 years, and then you decide to sell that policy, or you decide to cash in that policy, and then, you pass away and your family doesn't have enough money to make ends meet or for the final service. It just depends on where you are. I mean, if you don't need it, let's say if you're worth, $10 million, what do you need a life insurance policy for? If you pass away, your kids or your spouse, they're going to inherit everything that you have in terms of your assets. So I would try not to sell a life insurance policy unless I had to. But even, by the way, if you had a $10 million, if you had $10 million in assets, I still think you need life insurance so you can avoid estate taxes. And so, yeah, I'm against selling or even cashing in permanent plans, but I do believe in strategizing to take income from those permanent policies that could allow you more resources or more funds to make other investments and, manage your life or your economic life.
All righty. Next question is, what are some examples of blue chip equities?
Well, it's just, I don't know, Fortune 500 stocks. I mean, what, Nike, McDonald's. I mean, now you got CrowdStrike, you got all these technology companies, Apple, and these things, I mean, they go up and down. It's so crazy to, try to watch the stock market and predict what's going to happen. But, S&P 500 stocks, NASDAQ, you can just pick a company that provides a product that you use, right? It could be Under Armour, it could be Samsung, it could be Verizon. And these companies are very stable, but they have difficult years. They have sometimes they don't they don't have the right returns, or in terms of growth projections. They're losing money sometimes, or the reports are bad, or I don't know, the CEO could do something and now the value of the stock has gone down. So stocks are very risky, but it should be a part of your portfolio. As you get older, less stocks are better than more stocks, unless you know without a doubt that the stock that you invest in is going to give you a certain return, and you can't do that, right? I mean, I've purchased probably 150 different stocks over the last 2 years. I'm down to 4 now because all the other ones, may have gone up, but they went down, and I'm a little older, and I want to preserve what I have. I'm not interested in becoming a billionaire at this point. I just want to, make sure I get a good return on my investment.
Awesome, awesome. Next question is, briefly, please explain how insurance avoids estate taxes.
Did I say it avoids? No, it's no. So if you have, you set up a living trust or charitable, so you can set up these trusts that give you different ways to, take money out of your estate, so that, if you pass away, or even, when you file taxes, you're not responsible for, the capital gains on these assets, because, you put them in a trust, and the trust is the owner of those assets. People have large life insurance policies. Could you imagine being worth, $100 million? Your estate tax could be, $30 million. But if you had hypothetically a $30 million life insurance policy, well, your family can pay the estate taxes with that life insurance, the proceeds from the life insurance. So it's just a strategy. Life insurance products could be a strategy, or should be a big strategy, or part of your strategy for your estate plan.
All righty. Next question is, what do you think about annuities?
I love annuities. A lot of my clients have annuities, whether it's, a 403B, 457, be a 401k. I mean, anything you can do that would generate income for life, I think is intelligent, right? I mean, you have other options, and it depends on where you're investing your money. Is it, in the stock market, or is it mutual funds? But, generally speaking, annuities are designed to give you guaranteed income for life. It's almost like a pension, which nowadays very few companies offer pensions. But, back in the day, Michael Lawson, a lot of your friends and maybe you from your previous career, Gerald, and a lot of the people on the Zoom call, you had a pension, or maybe you still have a pension and you're taking distributions. But an annuity is like a pension. At some point, you start taking distributions, you're taxed on it because typically well, if we're talking about qualified plans, use pre-tax dollars to fund those annuities. And so you end up paying taxes on your distributions, but could you imagine, I have a client that, has $500,000 in a 403B. It's an annuity. And when they start taking distributions, they're looking at maybe $25,000 per year for the rest of their life. And they can also, some people have the misunderstanding that in their annuity, if they pass away, then it goes to the company or the bank or the insurance company. That's not true. You identify who you want to have the remaining balance in your account if you pass away. Matter of fact, most people who have pensions or people who have annuities, they can modify their distribution amount because they've named their spouse as the beneficiary. And so the beneficiary, it could be, they get 50% of the amount that the spouse was receiving before they passed away, or 25% or 100%. So to answer your question, I think annuities are great. It's just one vehicle to use for long-term planning.
Awesome, awesome. Well, that concludes our Q&A. Thank you,
Awesome.
Jaron. Thank you, Michelle, for sharing your insight and your knowledge. Since we all can't see each other, we're going to give a virtual hand of applause. And what is the best way in which people can contact you?
So Michelle, can you put that back on the screen? If Michelle is still managing, maybe she's not. There she is. All right, so there's the email. Contact us at retirementchoices.org. And that's the office phone number. And so, yeah, we'd love to hear from you and love to help you. If you have a situation where you need to talk about, what you have or what your parents have, or just, how you can create more wealth or preserve the assets you have, or creating a legacy, we'd love to help you. It's been wonderful. You guys have done a great job, Jaron and Jacinda. So thank you for your professionalism, and thank you for those that tuned in. And I look forward to seeing you at the next BWAARP Zoom call.
Thank you, Jaron, and thanks everybody for sticking with us tonight. Just want to remind all of you that our next workshop is on April 13th, and it's talking about crypto, whether we should cash in or cash out with crypto COO Nicole Franklin. A lot of stuff's in the news. Tune in on that evening and you'll get the real deal on what to do or not to do as it pertains to crypto. And then our final workshop on April 27th, The Wealthy Mind and Body, features a clinical psychologist, Dr. Rick Williamson, and family medicine physician, Dr. Derek Williams. So we're talking about mental and physical health as it pertains to money on that day. So please tell all your friends and family to register for our upcoming workshops at laul.org/BWAARP. So now we're going to have some closing remarks from the Urban League, starting with Los Angeles Urban League Director of Economic Development, Mr. Daniel Leathers, and he'll be followed by President and CEO, Mr. Michael Lawson.
All right, awesome. So thank you, Reverend Gerald, and thank you, JP, for that, or Mr. Hamlett, excuse me, for that awesome presentation. The three takeaways that I got were: if you fail to plan, you plan to fail. So really enjoyed that, and then also the power of compounding investing over time. So that was huge to see that the difference from when you just put money in a savings account to when you actually invested in the market. So, and then what I'd like to cover is that we have at the Los Angeles Urban League an entrepreneurship center that we want to make sure that everybody is aware of. And that program is, I'll drop it in the chat as well. It is laul.org/programs/entrepreneurship. And in that program, each year, the Los Angeles Urban League works with hundreds of Black-owned businesses, providing free consultations, coaching, and access to training, education, and funding. Last year, or excuse me, throughout the pandemic, the Los Angeles Urban League helped sustain small businesses with over $450,000 in grants. And we were recently awarded a grant through the Pepsi Foundation. And so want all those who are interested in entrepreneurship to come see us, and we offer the coaching free of charge. So at this time, I'll pass it back to Reverend Gerald, and we can continue forward.
Okay, so now we're going to hear from the president of the Urban League, Mr. Michael Lawson, with his closing remarks.
Thank you very much, Gerald, and thank you very, very, very much for this just enlightening session that we had this evening. This is exactly what we need to spend more time dealing with and thinking about, and recruiting people like the speaker that we had today. This information is not easy. This information is not easy to comprehend. This was what I used to do when I was a lawyer, and the issues that you heard are complex, but they're important. And so we need to reach out and find the professionals out there and excuse me, and prepare for the latter days of our lives. So tonight we completed another successful Black Wealth Attainment and Retention program. And my hats off to everyone that was on this program. And on behalf of the Los Angeles Urban League and the Parkside Economic Development Corporation, I thank Jaron Hamlett for his outstanding presentation. I also want to thank Gerald Smith, chairman of the Parkside Economic Development Corporation, for his leadership in presenting BWAARP, and Jacinda Moten for her continued support producing BWAARP. I also want to thank Michael Rodriguez for managing BWAARP's web series platform that you can find on our website, laul.org. And I also want to give a shout out to our Chief Operating Officer, Ms. Cynthia Mitchell-Hurd, who I believe was not here this evening, but she is a new addition to our team, and you are going to hear from her throughout this series. As we have said before, our mission is to build generational wealth for your families. Investment strategies are one of the necessities of creating financial stability, and you heard about it tonight. BWAARP encourages and promotes the strategies you heard this evening, and we suggest that you reach out to the professionals out there who have the information that you need in order to get this right. One of our goals is to more than amass dollars, but to rebuild Greenwood, the Black Wall Street in Tulsa, Oklahoma, that was destroyed in 3 days of rioting. And why was this city destroyed? Because they were so effective in the way that they managed their money. It was Black people buying and selling to and from Black folks. And that multiplication effort made them into one of the strongest economic institutions in the United States. We can do that again, but we have to do it with the understanding that comes from professionals that you heard tonight. So please continue to check our website, laul.org, for information on the work that we're producing here at the Los Angeles Urban League. And again, Gerald, I want to thank you again for another wonderful, wonderful evening.
I thank you for your support, Michael, and the Urban League support for BWAARP. And I wish everybody a great evening, and we look forward to seeing you in our next BWARP series. So you'll get some more enlightening information about some of the things you're hearing in the news, and you'll be able to make a better decision on if those investments are good for you in your future. And you certainly don't want to miss the last workshop, because again, if we don't take care of ourselves, the most important investment we can make is in our own health, physically and mentally. So Jacinda, thank you again. Daniel, thank you. Jaron, Michelle, you did a great job. Samira, we appreciate you making sure that everything is working in the way it's supposed to work. So good night, everyone, and we'll see you at the next BWARP.